Welcome to Flourish Conversations. I'm Kabir Kumar with Flourish Ventures. Today we are going to talk about open data for finance with my friend Olivia White, a senior partner with McKinsey Company. McKinsey Global Institute just released a study that both quantifies the economic impact of open finance and gives us a framework to understand how markets can capture the most value from open data for finance. This comes from joint research between Flourish Ventures and McKinsey. Before we get into the study results, I wanted to provide some context. As we emerge from this pandemic, we are seeing several mutually reinforcing shifts in how the financial system functions. First, the basic digital infrastructure for finance, accounts, payments, identity, is getting an upgrade. Second, this evolving financial technology stack driven by APIs is getting baked into a lot of our digital experiences like ride sharing, online shopping, and so on. AKA, everything is fintech or fintech is eating the world. Third, because of how finance will show up behind the scenes in different apps, our direct relationship with banks will change, and we are less likely to have the traditional single primary gateway to financial services, the landing account, the checking account, for example. Third, because of how finance will show up behind the scenes in different apps, the way regulators regulate financial institutions will change. How they oversee, how they supervise is changing. Flourish Ventures is investing in all of these spaces. And as those shifts take place, there are a couple of foundational and historic developments happening now that will determine if we build systems with consumers at the center and with a level playing field versus a winner-take-all model. One such shift is open data for finance. At Flourish, we believe open data for finance will help build a fair financial world. Because this is such a foundational development, we've partnered with McKinsey and the McKinsey Global Institute to understand what could be the economic impact and how markets around the world are positioned to capture this economic impact. Okay, let me bring Olivia in. Welcome, Olivia.
Hi, Kabir. Thanks. It's a pleasure to be here, and doing this research with you has been hugely valuable to me and to us.
So Olivia and I are going to walk you through the key highlights of our open data for finance study. As we do that, please feel free to comment and discuss in the chat section, leave us questions and ideas, and we'll try to get to them later. Okay, Olivia, to set the stage, let's pull up the slides here. So how do we define financial data and open data for finance for the purposes of this study?
Right, so a hugely important starting place. What we did was to take financial data to mean any data that's either created by or used during a financial transaction by a provider or by an individual. So then what's open data or open data for finance? We said that's the ability for financial data to be actually shared across financial institutions and with individuals in a way that requires limited effort for everybody, with a bunch of presumptions around protection of consumers and consent. With a bunch of presumptions around have open data or not, that can be driven either by regulation or by market forces, and we're quite deliberately agnostic as to what actually ensures data sharing. And just as a final note, to really get to the heart of this, we looked at 4 reference markets with particular closeness. And that was India, and then the UK, the US, and the EU. And we learn an awful lot about those individual markets, but also what we learn can be generalized, we think, in important ways to other developed and to other emerging markets.
So Olivia, we narrowed it to financial data and not data more broadly, even though other non-financial data can be used for financial decisions for the sake of the study. So we are able to quantify. What about these markets? Why did we pick these 4? You mentioned briefly at the end there, but could you say a bit more why these 4 markets?
Yeah, sure thing. So first on the developed markets, so the UK, EU, and US, those are all markets where there's really some meaningful amount of data sharing. But also markets that have really quite sophisticated and deep financial services sectors and systems. But the way that the open data works in those different markets and the progress that the markets have made is really rather different. So we wanted to get a range of lessons from what we looked at, and we'll talk about that a little bit more as we go. Now, India, on the other hand, is a terrific reference market among emerging markets. They thought awfully hard about open data, together with a set of other sort of tethered topics, including digital ID. And as a result, it's a great market for understanding the potential that might be there for other emerging markets, um, and a little bit about the ways that they might get there.
All right. So let's get to the punchline right up top.
Right.
So, what did we find, Olivia?
Okay. So look, the top line punchline is that even from a big macro GDP perspective, this is a conversation that matters. So first in the developed markets, so the EU, the UK, the US, the potential GDP benefit that's available, and we looked at it as of roughly 2030, is between 1 and 1.5% of potential GDP impact if open data really is taken advantage of. That's a really meaningful amount. It's not huge, but it's really meaningful and one that should get us to stand up and take notice. Now, bigger, in India, we found 4 to 5% of GDP might be at stake, so potential economic value there to be captured. And we anticipate that that number is relatively indicative of what might be there in other emerging markets, though, of course, one would have to do the more detailed research to really get the right number. So, top line, Kabir, this matters.
And so on this chart, we are seeing that the GDP impact by those four reference markets, but we're also seeing the attribution by the three key market participants. And there's an interesting story here across the market. So you look at India, for instance, where it's sizable on MSMEs. You look at US, for instance, it's sizable on financial institutions. Tell us a little bit more about how these markets are different at the attribution level.
Yeah, sure thing. So if you look at the right-hand side of this chart, we basically said, okay, let's look at the potential economic value that we found, top line, and try and attribute it by market participant. And in gray, the rough percentage allocation by individuals is shown. In dark blue, the rough sort of value or attribution to MSMEs, as you said, is shown. And then in the lighter blue, the rough attribution to financial institutions. So just reading the chart, you'll see, for example, in the EU, individuals would have roughly 17%, or call it 20%, attributed to them. Micro and small businesses, roughly 33%, and then financial institutions, 50, or sort of roughly up to half of the value. So look, a couple of top line observations about how this looks. The biggest one really is that this matters for everybody. So if you take individuals and MSMEs to constitute sort of consumers at large, and then financial institutions, the potential institutional benefit, in each of these countries, the value to institutions is meaningful, between 20, in the case of India, to 50% in the case of the EU. So it matters for institutions, but it also really matters for consumers, individuals plus MSMEs. And in fact, in each of these countries, over half or half of the value would accrue to consumers in a direct way. So top line, that's a real commonality. Now, as you pointed out, the actual details of the attribution do vary a little bit by market. In India, we see that really the lion's share of potential value goes to individuals and MSMEs. If you look at the bottom row, we think that's reasonably indicative of what will happen in many emerging markets. Reason that's happening is because there are a lot of people who are financially excluded or meaningfully underserved, and open data really harnesses the potential to try and bring those people into the financial system, or to do so in ways that are more efficient. So for example, making KYC less of a burden for MSMEs or for individuals. If you look at the EU, the UK, and the US, and all of those markets, the balance is slightly further shifted to financial institutions, with some variation across the markets. But nevertheless, in all of those markets, there remains real potential benefit for individuals and for MSMEs.
So meaningful GDP impact of open data for finance, and we have a sense of what it means for individuals, MSMEs, and financial institutions. Let's walk people watching this through how we came to that analysis. And I think there are three key pillars. So the first pillar is what's on this slide. So walk us through this, because there's lots happening here, but there's sort of 2, 3 key takeaways here that are the
Yeah.
main key pillar of analysis.
Yeah. So this is a little bit of an eye test, this slide.
Yeah, exactly.
But but I hope everybody will pass, and it says some important stuff. So if you look
This
down
is
the
not even the
center,
hardest eye test. This is not even the hardest eye test.
no,
There's a
no, no, no,
harder one
exactly.
coming. Right,
This
yeah.
is to prepare you for what comes in a couple
This is
slides. Exactly.
exactly.
So if you look at what's down the center, we've laid out the life cycle, the financial services life cycle. And really importantly, we've tried to define this both from the perspective of the consumer or the user and from the perspective of the financial institution itself. So on the left-hand side, what happens from the consumer perspective? Well, somebody first has to understand the product options available to them given their needs and narrow that selection set, ready to make a choice. Next, there's a purchase period where you choose what product or service and you purchase. Then there's a period in which you actually use that product or service. And then finally, depending, you may exit. From the standpoint of the financial institution, there's a period of design, product design, and then marketing. Once consumers have decided to make a purchase, you need to make a decision on whether to, in fact, sell them a product and at what price, and then onboard them. Third, there's analogous to the period of consumer use, there's servicing and monitoring. And then finally, potentially closure and termination of a product or service that's being offered. So that's what you see down the middle. We then said, given that financial services life cycle, let's think through the use cases that really matter. So specifically, what is it that might happen at the various different steps in that financial services life cycle that would be impacted by, in a value accretive way, open financial data? And to think through that, what we've done is to focus on banking and payments, which is what we think is where the real heart of value comes, but which also tells us things that are important and can be extended to both insurance and to asset management, though that's not the focus of this work itself. And within banking and payments, we found effectively 24 use cases that we thought really were meaningful enough that they deserved individual sizing of potential benefit. Those are the most eye test-like components of text within this chart. Now, they're divided into 7 different, you'll see, columns. Those columns link to the ways in which those use cases benefit either individuals and MSMEs on the left or financial institutions on the right. And we find effectively that there are 7 such ways, or what we call mechanisms, in our work. 3 of them link to benefit that goes in a direct way to individuals or to MSMEs, that is, to consumers or users. The first of which is increased access to financial services, right, which is what I mentioned when we were talking about India on the previous page. So allowing people newly to get access, for example, to credit products. The second is greater user convenience, again, for both individuals and MSMEs. And something like a simplified application or onboarding process falls within this category. Third, improved product options themselves. So, for example, improved access to competitive mortgages or other lending products, or also things like the ability to see various options for deposit yields across different products, and the ability to quickly shift if you see that you might be getting a better rate, for example, at a different provider. Now, moving to the right of this chart, we found that there were 4 broad mechanisms by which we could group use cases that benefit financial institutions. And most of these ultimately would redound to the bottom line of financial institutions. So the first, and this is a big one, is just increased operational efficiency. How do you market more efficiently? How do you underwrite more efficiently? How do you do automated KYC more efficiently? The second is better fraud protection. And this operates across the full value chain. The more data you got, and the more holistic data you've got, the better you can fight fraud. Third, improved workforce allocation. So how do you make sure that you have people focusing on the things that matter most and not wasting time on things that don't? So this is stuff like data-driven reorientation of your collection staff to focus on borrowers who might actually be high risk. And then finally, the fourth is reduction of friction in data intermediation. So the fact that there's potential for institutions, fintechs, traditional financial institutions, others who may be providing financial services to directly access data rather than to have to work through a friction-filled chain of aggregators, which can really be detrimental to economic value.
Well, for folks who are watching us, the big takeaway here is so we have the headline economic impact, right? Anywhere up to 4.55% of GDP, especially in India. And so how did we get there? And so one key aspect of that was to quantify a whole range of use cases, specific use cases, 24 of them that map to these 7 areas that you've just described, Olivia. And these 7 areas, interestingly enough, spread from consumers, MSMEs to institutions, and I think that's the sort of first pillar of our analysis is quantifying at that micro level of use cases under these 7 headline areas. And maybe we can illustrate. You already started doing that, but maybe we can illustrate a bit on the following slide what that looks like in each of these 7 areas.
Yeah, sure. And I find this is a really interesting look because it helps you start to see the real granularity of the work we did, but also the fact that this really does look meaningfully different country by country. So you really have to do the work. So let me orient everybody to this slide. First, for the columns, what we have is an example use case associated with each of the 7 mechanisms. And the 7 mechanisms are written across the bottom so that you can track. So for example, first column you'll see says increased access to financial services. And for each of these for each of these mechanisms, there's an example use case. So for example, for increased access to financial services, at the top, you'll see we look and try and quantify, what is the actual increase in the number of individuals who might receive credit aided by open data. Now, the rows are the countries that we looked at. So the developed markets, the EU, the UK, the US, and then India. And what we've done for each of these areas is to highlight the potential associated with each of the specific use cases. So for example, increase in individuals receiving credit, potentially roughly 20 to 25,000 in each of the EU and the UK, more like 450,000 in the US, and then in India, many, many more, right?
So let me interrupt. Yeah, let me
Please.
interrupt you there for a second, Olivia.
Please.
So if you take that left hand of this slide, we are talking about one of the 7 areas of, as you call them, mechanisms. This is improved access to financial services. It's the one that we believe has the biggest implications for individuals, for consumers. And then what we are showing here is one aspect of that, one of the use cases within that mechanism, which is increase in individuals receiving credit. And what we are quantifying here are the people, the sort of who is likely to benefit from that. What's the size of that across the 4 reference markets that we looked at? And you just walked us through what that looks like, EU versus India, for instance.
Exactly. And you'll see that, for example, for this mechanism in this use case, the potential gain in India is really significant. And that's why the associated circle is a different sort of lighter blue and highlighted.
Could we talk about the fraud cost savings one? That's sort of the third one from the right. So this is now the mechanism of better fraud protection. And as people watching this will remember, this is the one we are attributing to institutions. This is one of the 7 mechanisms we believe is where the benefit will accrue to institutions. And here we are quantifying a specific use case, which is fraud cost savings under that mechanism and across the 4 reference markets. Maybe you can walk us through this one, Olivia, because I find this very interesting, how the different markets compare.
Yeah, sure. So this is a case in which you actually get a meaningful uplift in each of the markets, but by far the biggest uplift in India. Roughly what's happening here is that in the EU, the UK, and the US, there really remains a lot of potential benefit, for example, by attacking synthetic identity fraud across markets, which could be gained by, and I mentioned this on the previous slide, by institutions having access to even more data so that they could put together real patterns of consumer or fraudulent consumer behavior. In India, the number's even bigger, partially because the degree of sort of patched together options right now that financial institutions use to fight fraud is much more limited. And a lot of fraud comes through channels that end up taking advantage of what looks like sort of more manual processes today, where the open financial data and increased de facto data sharing associated with that could yield some real uplift.
And then the other thing that's noteworthy here is where does the US show up more prominently, right? Where the impact is the greatest. And it's in three of the use cases that are shown here. And as you mentioned earlier, there are 24. So we're not showing all 24 here. We're just showing one per mechanism, one per seven mechanism. So of the ones that are shown here, there are three where we are saying US is likely to accrue the greatest benefit from open data for finance. So quickly highlighting those three, and then I have a question for you about fintech innovation. I have a view, but also a question for you about fintech innovation.
Sounds good. Sounds good. So the three that are highlighted here are first, you'll see the fourth column, which is cost reduction from streamlined data entry into CRM systems, which ties to increased operational efficiency. Second to the last column, targeting of collections teams towards high-risk borrowers, and this links to improved workforce allocation. And then finally, final column, reduction in total ad impression costs for financial services, and this links to reduced friction in data intermediation. So the cost reduction from streamlined entry into CRM systems, this has to do with just the amount of flow through the system, particularly things like mortgage markets. Better data means better use of that data, and the more you're looking at a real aggregate point of view of data, the more potential benefit. Targeting of collections teams towards high-risk borrowers. This one's maybe worth talking about a little bit. U.S. gets potential benefit here that far exceeds that in other countries, partially because of the dominance of credit card use in the U.S., where there's a lot of cost associated with collections on credit cards, but also a lot of direction of individual, or some direction of individual workforce to people who may not prove to be high risk. So there's potential saving. Do people need to be doing that work? And then finally, reduction in total ad impressions costs. That has to do with the fact that the sort of market-based view of data sharing that we have in the US means that there is additional friction within the system, and therefore a bit more potential value to be gained in the US versus the value to be gained particularly in the EU and the UK.
I'm thinking, so I'm a fintech that's offering a financial health product based on access to checking account data. As you know, we have a number of those in our portfolio. Where do they fit in this analysis? And I see two or three areas where they fit in, right? So they are making it, they are bringing benefits to consumers, to individuals because of what they are doing. And so their actions are likely to increase access to credit. So they are in that first column on the left. They are part of what's making that happen. And I think they're also possibly in the third column from the left, which is where we've quantified these deposit yields through easy account switching. So they are giving information, data, insights to consumers to allow them to find the best product, the best match product for themselves. I think broadly for fintech innovation, I see credit access, KYC, fraud reduction, even data intermediation, right? Data intermediation is interesting because what it's saying is that there are so many places I have to go to get data, and I'm bilaterally or 1 to 2 or 1 to 3 trying to aggregate data. But if there's someone that's giving me a single pipe with a simplified API to a lot of data, if I'm reducing that data intermediation cost, and that's also beneficial. So I see fintech innovation playing a role in all of these areas. What do you think? How do you think about that space?
Yeah, I think that's all a very fair thing to say. Look, at a high level, let me just add something complementary. I see three broad categories of space where fintechs can play, and I think they'll map reasonably well to what you've just laid out. So, one is fintechs that actually provide directly to consumers products or services that are improved, um, that are easier to use, or that people otherwise wouldn't have access to. Note that here you're helping the consumer, but you're also potentially going to be able to grow or to compete for consumers if you're offering something that's better than what the rest of the market is offering. Um, Big second category, solutions that will actually help financial services providers, regardless of who they are, banks, fintechs, other, provide products and services more efficiently. This is more of a B2B play, but still, again, super important. So think about improved fraud, for example. Um, then third, there's a category of fintech providers who are actually helping create the rails, or more broadly speaking, innovators who are helping create the rails that allow open data or open financial data to flow in the first place. Where, Kabir, I like the way you put it. I guess one other thing I'd add there is the more you actually have the ability to do these things in a standardized and somewhat aggregated way, the better able actually you're also able to manage things like consent or correctability of data where
Hmm.
something fraudulent happens to an individual consumer or life circumstances change. If all of this is happening only in a bilateral ad hoc way, it's extraordinarily difficult to come up with mechanisms by which you correct errors and
Yeah.
keep the data that's flowing current.
So headline takeaway: 1 to 4, 5% of GDP across markets. And we were able to quantify that because we looked specifically at a range of use cases, 24 of them. We just covered a few of them in these slides that map to these seven mechanisms, as you described them, seven areas, seven mechanisms. So that's one pillar of how we got to that GDP impact figure. The other pillar is sort of, are markets really well positioned to capture this economic value, and what are the sort of forces or factors driving that? So let's shift to talking about that, Olivia, and help people watching this get through. This is the stuff that I'm really excited about because we are able to then guide markets on how to think about open data for finance if they're at the beginning of their journey. So
Yeah.
so there are really two big factors in terms of whether markets are positioned to capture this value, and they're described here. And again, we have some data to characterize, or some indication to characterize where our reference markets are.
Right. So let me actually start this slide by saying it is really easy to start talking about all of the complexities of open data and the complexities of different systems. There are hundreds of variables that one might look at and that need to be considered when somebody actually works through the specifics of an open data regime.
Yes.
But what we
Yes.
tried to do was to distill it into what really is allows us to make generalizations and to link, as you said, Kabir, what markets are actually doing with the potential that they have to capture the benefit we saw in our use cases. So, with that as a sort of introduction, on the
Yeah.
left, we called out two main dimensions, each with some sub considerations. So, the first main dimension is what's the level of standardization that allows data sharing to occur. So, does the mechanism for data sharing rely on manual data transfer, potentially in a pairwise and ad hoc way? Or are there standardized APIs or some other mechanism which means that everybody can share in the same way with the same formats? And then linked to this, there's the question of price of data access. So is that something that's high price, opaque, potentially differing for each pairwise ad hoc interaction? or is there free and standardized API access or free and standardized pricing? So that's one big clunk of how to quantify or how to think about systems. Second big clunk is the breadth of data sharing itself. So is the type of data shared just a limited subset of financial data available, say just particular payment transactions linked to specific use cases? Or is it real broad sharing of data, broad types of financial data across all different use cases? And then the second
Yeah.
subcomponent to that is what's the driving force behind that data sharing in the first place? Is it market based? Is it regulation based? Is it some combination of those two? And we use those dimensions to look at or to give a sense of what was happening in each of the EU, UK, and US, as well as in India. And really interestingly, there are a couple different patterns that emerge. So one sees a sort of prototype in both the EU and the UK that you'll see here that ties to high degrees of standardization. And you'll see this in the first two rows for both the EU and the UK, but significantly lower degrees of breadth of data sharing because the type of data shared is actually more limited in both of those two markets, linked to payments almost exclusively in the EU and then transaction data in the UK. In the US and India, the pattern is a little bit different, albeit with some real shifts, or excuse me, some real differences between the US and India. So in both of those markets, you'll see that the degree of standardization is more limited, particularly in the US, but the breadth of data sharing is quite high. So much more close to all types of financial data have the potential to be shared. In the US, this through a sort of market-based mechanism whereby all data is really very much at play, but there's not standardization. In India, you'll see standardization is actually quite a bit higher. And again, the type of data shared, the breadth of data shared through the India stack is in principle actually rather high. So we get real different types of prototypes in these different markets. I should say, right, back to my first comment, there's a lot of complexity that's not captured in this view. So if you want to get all of the details exactly right, you need to go deeper. But we really do believe that this kind of way of looking at things can help you sort through some of that complexity and start to make real conclusions about where to look to try and gain value.
Excellent. And so it really, two main drivers really, the standardization, which you explained, which is really driven by sort of the regulatory forces in some markets, whereas in some markets it could be driven by private actors. And then there's sort of the breadth of what kinds of data is being shared and then elements behind that. These are the two big factors. And then, so now we're going to bring the first piece of our analysis, which is the use cases and the very granular micro analysis of these 24 use cases mapped to those 7 mechanisms, along with this 2x2, this mechanism of data standardization and data share and breadth of data sharing. Okay. And so this is the real eye test. Okay.
Exactly.
I think I call it the McKinsey chart torture method of learning. So let me do an attempt here, Olivia, very quickly. So first, folks, you're looking at this, don't run away. I'm going to walk you through this. So first is the bubbles you see on this slide represent the economic value from each of those 24 use cases that we've been mentioning. So, the size of the bubble is the value. You can see that across all of those 4 charts in there. And you can see those 24 use cases actually listed on the right-hand side of this chart. And then we are showing the value as it is mapped to those 2 areas that we just talked about, the breadth of data sharing and the level of data standardization for each of those 4 markets, India, US, UK, EU. And then third, you might have noticed, is that there are these little gray boxes in each of those 4 charts. And Olivia, why don't you walk us through why they are of different sizes and what does that mean?
I will do that. One more point of orientation to this chart, and as
Yes.
Kabir said, I hope everybody trained and paid attention during our initial preparatory eye test. Take two different use cases as examples. So if you look at 2 and 3, you'll see 2 and 3 show up on each of these charts, and you'll also see them on the right. So 2 is newly allowing access to retail credit. through alternative credit writing directed towards SMEs. And you'll see in each of the charts, India, US, UK, and EU, there's a bubble that's sort of midway to the left and midway up on breadth of data sharing in each chart. You'll see that in India, that bubble, that two bubble, is big. And in fact, it's the biggest bubble on that chart. That represents the fact that there are a lot of MSMEs that aren't, in fact, in the formal financial system today in India. If you shift to the US, you'll see that that two bubble is still reasonably sizable, though smaller than it is in India. And then
Yeah.
when you look at the UK and the EU at the bottom, you'll see that that two bubble is somewhat smaller than it is in either India or the US, indicating more financial inclusion of MSMEs in both the UK and the EU. So that's Kabir's point about the size of the bubble. The gray box.
The gray
Let's
box.
look at
Yeah.
the gray box. But I just, let's look at India first. So that gray box says, here's where India is today on level of data standardization and breadth of data sharing. You'll remember from the slide previous, we said that in both of those dimensions, India is actually reasonably well along towards a high level of data standardization and breadth of data sharing. So you see a gray box that's actually reasonably big with respect to the size of the full range of use cases that we look at. Now, that gray box includes that number two, right? The newly allowing access to retail credit through alternative credit underwriting. That means that in principle, given the way that the data ecosystem is defined in India, that use case number two is in principle something that India can capture and gain value from. Now let's look at the
Yeah.
US. And you'll remember from the slide that we talked about before, we said in the US, the breadth of data sharing is high, right? There are lots of different types of data that are shared, but standardization is low. And that's why you'll see a gray box that's tall, but very skinny. And it doesn't even capture that too. So there's potential value there, sort of in theory, from newly allowing access to retail credit through alternative credit underwriting in the US, but it's not within the range of accessible use cases right now, given the way that the data ecosystem is construed. Now
Yeah, and
let's
so
go
in the
down.
US context, yeah, if we just stayed with India versus US for a second,
Yeah,
in the US context, if we increase standardization, let's take the financial data exchange standard is widely adopted across all sorts of data uses.
yeah,
If the Consumer Financial Protection Bureau actually acts on 1033, the Dodd-Frank Act, these are just examples of what it means to go down the line on data standardization, and that gray box expands, then the quantified value that you see there from those bubbles can actually be realized by that market, which is now not being realized. And when you say that that's very tall on breadth of data sharing in the US, what you're saying is, yeah, we have Plaid, Finicity, and others. You have Alloy in the KYC space. They are making access to different kinds of data available, but it's private driven. And we are confident that the private sector will make more and more of that available. Payroll data, number of startups have come up in recent months, for instance. But we will still not be able to get to that full economic potential if we don't act on the standardization and expand that box to the right.
precisely right, precisely right. And I should say, there are probably, given the sorts of innovators that you talk about, there is some of the value from use cases that aren't within the gray box that can start to be achieved. It's
That's
not
right.
as if you have
That's
to,
right.
but not all of
That's
it.
right. That's right.
Yeah.
That's right. So quickly on UK and EU, and then I want to take our folks who are listening to what does this mean for markets that are at the beginning of this
Yeah.
journey.
So UK and EU, as you'll remember from the previous slide, a very different kind of archetype, if you will, on what the open data ecosystem looks like right now. So there you'll see a gray box that is long but squat. So the level of data standardization as prescribed, actually high, really high, but the breadth of data sharing limited to a much narrower set of types of data, and that's why those gray boxes are relatively short. Take our use case
Yeah, and in
number
fact,
two.
yeah, I was going to say
Yeah,
quickly, Brazil, for instance, where it is today, might be similar to UK, but given their plans, they might eventually start to look more like India because they will allow for all sorts of data being available over time, given their agenda and their plan. But right now, they're likely to look like the UK market for a period of time.
In some ways, that's a great seg to this question about innovation and where the market comes in. Because if you've got a gray box that's limiting, well, innovators are trying to capture as much as they can within that gray box, but really, can innovation help them get at least some of the value that's not in it? On the other hand, once that gray box really starts to encompass um, meaningful use cases that might give you real value, okay, now over to the innovators to figure out what products to put in place. How do you actually capture that value in ways that help either institutions or individuals, and then is also profitable for the provider? I mean, but Kamir, how do you think about all of this yourself from where you sit?
Yeah, I think I see, um, you know, probably two ways in terms of what this means for innovation. I think first is, how do we capture the full value from what is possible today with the levels of standardization data? I think that's what you were talking about earlier. So you have the 24 use cases. I think that's a great universe. And I know you said it can be far more complicated and many more use cases, but that's pretty good enough. And there are limits. It's not the full economic value, but can startups play a role in capturing value from those use cases based on where data sharing and standardization exists today already? And then I think the second part of this is that if we get more standardization and we get more data sharing, that we were talking about the US, we were talking about the UK, I briefly mentioned Brazil, we not only are we going to expand to capturing value from more use cases, it's going to open up potentially new cases we haven't even thought about. And I think that's what's really exciting, is that it will expand that frontier of innovation and frontier of innovation. And let me bring up this slide as our sort of final slide here, which is sort of simplifying this framework with the two factors: data sharing, standardization, and then the use cases mapped to those, basically aggregated to the 7 mechanisms that we've had. And so, say a bit more about what this means for markets at the beginning, Olivia, from your perspective of this journey.
Yeah, sure. So this really allows you to say, hey, look, at a high level, here's the level of standardization I need and the breadth of data sharing I need to capture the bulk of the value associated with any one of these mechanisms, right? So increased access to financial service, for example, sort of an intermediate level of each. And that's true for the other mechanisms linked to consumers too. So the greater user convenience and improved product options use cases. And then for the mechanisms benefiting financial institutions, to really really recoup them in full, you need more standardization and also a broader breadth of data sharing. So I can look at this if I'm a market and say, hey, where do I sit today? And what sorts of use cases do I really want to start to target? And that's sort of from a high level. But if I'm an innovator, I think, and Kabir, I'd love your sort of reaction to this, I can say, look, given where my market is today, where is it that I really want to double down and make sure that I'm taking advantage of perhaps the value that's immediately accessible? And are there places where I sort of want to push the frontiers, even given the constraints that my market may be placing based on the level of data standardization and breadth of sharing?
Yeah, I think you're absolutely right. I think if there are standards and they apply to a broad category of data, that makes it a lot easier for innovators. And but if there are limited standards and then on top of that they apply to a smaller set of data, that's a lot harder for startups to overcome. And that's why I think it's exciting what's happening in India, right? That there is already sort of building blocks in place. If you are an innovator, I mean, there are broader challenges to start a business and get going in India relative to the US. But if you can get that going, that's pretty significant because the building blocks are in place. I think in the US, we sort of have some of the answers. We need to act on them. I think if we get to, the FDX standards, if we get to what I mentioned earlier, then the scope expands and it's a lot easier for startups to act against that framework. Olivia, thank you so much for walking us through this important research And thank you, all of you, for joining me and Olivia in this conversation to introduce this research. The paper is available for download via the McKinsey Global Institute website. It's also available via the Flourish Ventures website. And of course, we always look forward to hearing from you about our work, our portfolio, and our impact. Please write to us. Our contact information will be up shortly, as well as the links to where you can download this paper. Thank you so much.
Thank you, Kabir. And thanks, everybody.